Hey option traders, for today's trade we're looking at an option strategy known as a cash secured put in the iShares MSCI United Kingdom ETF. This is a great strategy to use if you're looking to buy a stock or ETF at a price below the current one, or it can give you a nice boost in the yield. The ETF contains a number of notable stocks including oil and gas giant Shell, AstraZeneca, Rio Tinto, BP, and GSK to name a few. Looking at EWU on MarketSmith, shares have been consolidating since mid-January. The stock started drifting sideways after a powerful run higher in the final quarter of last year. The consolidation gave the moving averages some time to catch up. Despite popping below the 21-day line a few times, shares have held strongly above the 50-day moving average. Investors wanting to take ownership of EWU can potentially do so at a reduced price with a strategy known as a cash secured put. This option trade is slightly less bullish than buying the stock outright. It involves selling an at-the-money or out-of-the-money put while simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium, or be assigned and acquire the stock below the current price. Selling put options is a very easy place for investors to start with options. They are kind of like a covered call and are pretty easy to understand once you know the basics. So with all of that said, let's take a look at my trading platform and set up a trade using EWU. With EWU trading around 33 a share, investors can consider selling a July 21st expiring put with a strike price of 32 for around $1.25. An investor selling this put would receive $125 into their account, which would be theirs to keep. If EWU falls below 32 by July 21st, you would be required to buy 100 shares at $32 a share. The effective net cost of the position would be $30.75 thanks to the option premium received. That's 5.76% below yesterday's closing price. If the stock stays above 32 at expiration, the put will expire worthless and leave the trader with a roughly 4% return on capital at risk. That works out to be 10.3% annualized. The main risk with the trade is similar to outright stock ownership. If the stock falls quickly, the trade will suffer a loss. However, the premium received will help to offset this loss. The maximum loss in the trade would occur in the highly unlikely case that EWU fell to zero, which would see the trade lose $3,075, but most traders would cut their losses long before then. This is very unlikely, as it would mean that all of those UK stocks in the ETF would have to go to $0, in which case we'd have way bigger problems than just losing $3,000. As always, remember that if you're new to options, make sure that you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us here for our regular options content where we discuss a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.